Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Want to discover the secret sauce for building wealth in the stock market? Or maybe you're curious about how a simple investment approach can lead to financial success, regardless of your educational background? Let's learn from the investing guru himself, Peter Lynch. I've condensed his invaluable teachings into 4 essential lessons that will revolutionize your investing game. What makes his strategy so appealing is its sheer simplicity. No matter if you've got a fancy MBA from Harvard or you're a wizard in data science from MIT, you can easily follow in his footsteps and achieve financial victory. Luckily for us, Lynch has generously laid out his investing gems in books and interviews. We will be sharing these golden nuggets with you today. If you find value in this video, I would greatly appreciate it if you could give it a thumbs up and subscribe to the channel. Creating these videos requires a significant amount of effort. As Lynch suggests, anyone can become a successful investor, so make sure to watch until the end to fully grasp what he means. Let's dive into the 4 investing lessons from Peter Lynch, but first, we need to understand something really important. Nobody is born a natural investor. It's not like having a special talent that runs in your family. Actually, even Peter Lynch's own relatives were wary of the stock market because of what they went through during the Great Depression. And here's the best part, you don't need to have a super high IQ to succeed with Lynch's strategy. Lynch views investing as more of an art than a precise science. According to Lynch himself, as long as you can do simple math and come up with an answer close to 4 when adding 2 and 2, you've got enough smarts to make money in the stock market. Now let's move on to the first lesson, knowing your edge. This is crucial because many individual investors are unaware of the knowledge advantage they possess. It's true that having comprehensive knowledge about every single stock out there can be quite a challenge. But who says you need to know them all? In fact, narrowing down your focus to a handful of stocks that you know exceptionally well can be a smart move. By honing in on those 10 to 15 stocks that you have a deep understanding of, you're placing yourself in a position of expertise. And guess what? That expertise can lead you to uncover some hidden gems in the market. See, Wall Street tends to have its radar fixed on the big players, the well-known companies that attract all the attention. However, there are countless smaller companies just waiting for their moment to shine. These are the ones that often slip under Wall Street's watchful radar. That's where individual investors like you come in. By casting your net wider and paying closer attention to these overlooked companies, you may stumble upon some real winners. And with today's easy access to the internet and all its resources, you have an incredible advantage at your fingertips. So go ahead and utilize those available resources effectively. Start with the industries or sectors you are interested in, research these hidden gems, dive into their financials, understand their business models. Who knows? You might just discover an investment opportunity that turns out to be incredibly rewarding. Remember, it's not about knowing every stock out there, it's about knowing a select few really well and exploring untapped potential. Moving on to lesson number 2, knowing which stocks to avoid is arguably even more critical than knowing which ones to buy. Let's look at Jeff, who is an average working man like you and me. Jeff has saved $10,000. He decides it's time to put his savings to work by investing in the stock market. Now here's where things get interesting. Jeff follows a financial blogger for a while and believes the investment advice he receives leads to the ultimate stock that will make him rich. Caught up in the hype and without much knowledge about investing, Jeff takes a leap of faith and invests his entire savings into this supposedly can't-miss stock. But reality hits hard. The stock that seems so promising ends up being a complete disaster, losing a whopping 50% of its value. Now, Jeff finds himself with only $5,000 left in his investment account, a far cry from the $10,000 he started with. In order to just break even and recoup his initial investment, Jeff would need to find a miracle stock that skyrockets by 2 times its current value. And let's face it, that's not easy. This cautionary tale perfectly highlights the wisdom shared by legendary investors like Peter Lynch and Warren Buffett. They often stress the importance of not just chasing after every shiny opportunity, but also knowing which stocks to avoid. As Charlie Munger famously put it, "I want to know where I'm going to pass away so I never go there." In other words, achieving success in investing is often about steering clear of foolish mistakes rather than solely striving for perfection in every aspect. So let's take this valuable lesson to heart, remembering that being aware of what not to do can be just as crucial as making wise investment choices along the way. With the markets on a sharp rebound in 2023, many investors who are on the sidelines are getting impatient and want to jump on the wagon. Peter Lynch saw this coming many years ago. When it comes to stocks, steer clear of those flashy next big thing investments. Sure, they may seem tempting with all their hype and buzz, but trust me, they often come with sky-high valuations. If anything doesn't go perfectly well with the rosy forecast, you could be looking at some serious losses. Another stock to avoid are companies that jump headfirst into random markets without a solid reason. These companies think they're being clever by diversifying their business portfolio, but in reality, it usually ends up hurting their shareholders. So be on guard for these unnecessary diversifications. Thirdly, Lynch wants you to watch out for what he calls dependents. These are companies that put all their eggs in one basket by relying heavily on just a few clients for a big chunk of their business. Sounds risky, right? Well, you guessed it, if those key clients decide to take their business elsewhere one day, it can spell major trouble for the stock price. So let's recap before moving on. Avoid the overhyped next big thing stocks with inflated valuations, run from companies making random diversifications without good reason, and be cautious of those dependents hanging on by a thread with just a handful of clients. Take this advice to heart and you'll have an extra edge when navigating the wild world of investing. Alright, let's dive into lesson number 3. Many investors have this strange habit of selling the stocks that are bringing in big wins while stubbornly buying more shares of the ones that are heading south. Have you ever done that in your investment? Behavioral finance plays a role in this phenomenon, particularly the concept of loss aversion. Humans tend to dislike losses more than they enjoy equivalent gains. This bias often leads investors to sell winning stocks prematurely, fearing that gains might evaporate. Peter Lynch compares this behavior to watering the weeds and cutting the flowers. I mean, who does that? If you want your garden to thrive and flourish, you gotta let those beautiful flowers bloom and grow, not waste your time and energy on those pesky weeds. So if you want long-term success in investing, you need to resist that impulsive urge to sell your winners too early. Don't sabotage yourself by getting rid of those stocks with significant gains just because they're doing well. Keep them in your portfolio and let them reach their full potential. Trust me, your portfolio will thank you for it in the end. Lesson number 4 is to focus on the microeconomics rather than the macroeconomics. Many investors make the mistake of worrying about the overall economy instead of focusing on specific companies and industries. Microeconomics studies individual and business decisions, while macroeconomics looks at national and governmental decisions. By focusing on the microeconomics of a particular industry, investors can gain insights that professionals might overlook. By avoiding stupid mistakes, knowing which stocks to avoid, not selling winners too early, and focusing on the microeconomics, investors can increase their chances of success. Remember, investing is a continuous learning process, and understanding the lessons from great investors like Peter Lynch can greatly improve one's investment journey. Thank you for joining me on this insightful journey into the investing wisdom of Peter Lynch. I hope you found these 4 essential lessons as valuable as I did. Now, it's time for you to take action and revolutionize your investing game. If you're ready to discover the secret sauce for building wealth in the stock market, then hit that subscribe button and join our community of passionate investors. By subscribing, you'll never miss out on future videos packed with valuable insights and strategies. I'd love to hear your thoughts on Peter Lynch's investing lessons and how they've impacted your investment approach. Leave a comment below and let's start a conversation. Your input and experiences are invaluable to our growing community. Thank you for watching. See you soon.